Gold investors think they already know the story. Rates fall, gold rises, simple. But the data coming out right now blows that belief apart. Because for the first time in decades, gold isn't just moving, it's breaking its own rules. And one of the world's biggest banks says 2026 won't just be strong, it could rewrite the entire playbook. And here's the part no one's paying attention to. While everyone is obsessing over gold hitting new ranges, silver is quietly diverging. And an unexpected third metal is about to steal the spotlight. If you think the precious metal landscape is predictable, this next year is about to prove you wrong. You're watching Gold Rush Reporter, the place where we cut through the noise and stay ahead of the market, not behind it. If you're serious about making sense of what's coming, pay close attention, because the signals forming right now won't stay quiet for long. All right, let's get into why this discussion even matters today. This entire story was triggered by Deutsche Bank's latest outlook, a report that doesn't just update price targets, it challenges mainstream assumptions about demand, supply stress, and which metals are actually leading the next cycle. Analysts aren't reacting to price action. They're reacting to a structural shift forming underneath it. And the most surprising part? Gold isn't even the metal with the most explosive upside in their forecast. Most people still think gold moves because of retail excitement or social media hype. Wrong. The real engine right now is institutional behavior, specifically central bank accumulation. They don't buy gold to invest. They buy because they're repositioning their reserves away from politically vulnerable assets, especially the US dollar. That's why Deutsche Bank calls this cycle different. Banks aren't reacting to price. They're ignoring it. When buyers with that kind of balance sheet soak up metal without caring about premiums or timing, they tighten supply for everyone else. And that's exactly what's happening. Mine output hasn't kept up. Years of underinvestment, operational failures in major regions, and declining ore grades have created a structural slowdown. Recycling should help, but it's still far below previous peaks. Gold isn't scarce because of hype. It's scarce because production is flat, while sovereign demand keeps expanding. Another misconception. People assume falling rates automatically push gold higher. That's outdated thinking. What's really moving the market is liquidity pressure and credibility loss in monetary policy. Investors don't trust long-term inflation numbers, and they're preparing for another wave of balance sheet expansion once the new Fed leadership steps in. That's why ETFs, which were selling for 4 straight years, have flipped back to accumulation. They respond to macro uncertainty, not short-term price swings. But here's the part most retail investors overlook: COMEX stress. Lease rates rising isn't some random metric. It's a sign that short-term physical availability is tightening. When borrowing costs jump, it tells you the system is struggling to source metal quickly. That's not a bullish cheerleading argument. That's a supply chain warning. So, while people keep expecting a price crash or some magical reset, the data says the opposite. You don't get deep corrections when both official institutions and ETFs are fighting for a limited pool of metal. You get elevated prices with shallow pullbacks, exactly what Deutsche Bank is modeling for 2026. And here's the key insight. Gold's strength isn't speculative. It's structural. If you remove the noise, this market is being driven by slow supply, persistent sovereign demand, weaker monetary credibility, and tightening physical availability. Retail hype didn't create this environment, and retail selling won't break it. But gold isn't the whole story, because silver's behavior doesn't match gold's pattern at all. And that difference is where the real tension starts. The forces we broke down in part 2 don't exist in isolation. They shape every move in gold and silver. And this is where most investors get the story wrong. Let's start with gold. When central banks accumulate without reacting to price, it creates a floor. Not because the market is bullish, but because the biggest buyers simply refuse to sell. That reduces circulating supply and compresses volatility. So the idea that gold will tank back to 2000 ignores how institutional behavior actually works. You can't get a deep crash when the main buyers aren't traders. They're sovereign reserves locking metal away for years. Short term, this creates narrow pullbacks and fast recoveries. Long term, it creates a slow, grinding trend upward, which is exactly what we're seeing. And that's why Deutsche Bank's forecast is grounded, not exaggerated. Elevated prices with limited downside as supply struggles to expand. Now silver. This is where people get dangerously optimistic or unnecessarily pessimistic. Silver doesn't follow gold. Silver reacts to stress, not stability. When the physical market tightens, from solar demand, EV growth, or falling inventories, silver moves faster than gold because it's smaller and more sensitive to ETF flows. But when liquidity dries up or industrial buyers pause, silver pulls back harder. That volatility makes people believe in fantasy scenarios like $200 silver overnight. Unrealistic. Silver isn't exploding because Reddit wants it to. It moves only when supply chains and industrial users get squeezed. Right now, the data shows both pressure and limits. Exchange inventories are falling. Mine supply isn't keeping up. Lease rates are climbing, a sign of short-term scarcity. ETF behavior is shifting after years of stagnation. But here's the uncomfortable truth most analysts won't say. Silver can be tight and still underperform if investors hesitate. And investor hesitation is real, because silver's last major run retraced fast, and people remember that. Psychology matters. Fear of being trapped matters. Silver needs consistent stress to outperform, not occasional spikes. Short term, expect choppy movement, strong rallies, sharp pauses. Long term, pressure builds from industrial demand that isn't slowing down, especially in solar and electronics. That's why Deutsche Bank's forecast looks conservative. They're modeling averages, not extremes. But the real point everyone is missing, the one factor that will determine everything, is simple. Silver's fate depends on one thing: whether investors believe the tightening is temporary or structural. If they treat it as temporary, silver stays capped. If they treat it as structural, silver behaves like a leveraged version of gold. And that mental shift hasn't happened yet. If you connect the current signals with how these markets behave under stress, the next phase becomes clearer. Not predictable, but logical. For gold, the path forward depends on one catalyst above everything else: liquidity. When central banks keep buying while supply stays flat, any liquidity expansion, rate cuts, balance sheet growth, geopolitical shocks, or a weaker dollar, amplifies upward pressure. It doesn't create a vertical spike, it creates a persistent drift higher because investors don't want to fight sovereign demand. Short term, gold's biggest risk isn't a crash, it's stagnation. If ETFs hesitate, or if markets price in soft landing narratives, the metal stalls. Not because fundamentals turn bearish, but because investors temporarily convince themselves they don't need safety. That's fragile thinking, but markets move on stories, not truth. Long-term gold benefits from exactly what institutions fear: unreliable inflation control, political instability, reserve diversification, supply that refuses to scale. None of these reverse quickly, which means the structural direction remains upward, slow, steady, not dramatic. Silver's next chapter is trickier. The industrial engine is real, and the supply tightness is measurable. But the market is vulnerable to one thing silver investors always underestimate: liquidity shocks. When liquidity dries up, industrial buyers delay orders, ETFs pause, and silver retreats faster than gold. That doesn't invalidate the long-term squeeze. It just shows how sensitive the metal is to macro fear. The real risk isn't that silver collapses. The real risk is that people expect a runaway market. The structural deficit grows, inventories shrink, mine output lags. But unless investors treat this tightness as permanent, silver will continue to swing violently instead of trending smoothly. That's why Deutsche Bank's average price looks underwhelming. They're accounting for chop, not fantasy. Here's the part most analysts miss. Both metals depend less on bullish energy and more on stress transmission. When monetary policy weakens, liquidity expands, and geopolitical uncertainty builds, that stress moves capital into gold first. Silver follows only when the pressure becomes undeniable, when industrial users start getting squeezed and ETF flows return. Gold leads, silver reacts, and platinum, as we'll get to, is already in a different trajectory entirely. The market right now is fragile, not euphoric. Anyone waiting for a straight line explosion is setting themselves up for disappointment. But anyone ignoring the structural tightness is missing the larger direction forming beneath the noise. When you strip away the noise, all three metals point to the same truth. This market isn't being driven by excitement. It's being driven by structural pressure. Supply is slow, institutions are repositioning, liquidity is unstable, and geopolitical risk isn't fading. That combination creates a landscape where metals don't need momentum to move. They just need time. Gold shows what happens when sovereign demand collides with a tight supply base. Silver shows how volatility masks a long-term squeeze that's already forming. And platinum shows what a real structural deficit looks like when no one's paying attention. The deeper opportunity and the deeper risk is misunderstanding the cycle. If you treat this environment like a short-term rally, you'll misread every move. If you recognize it as a long-term shift in how capital flows during global uncertainty, you'll understand why these markets behave the way they do, and why they're unlikely to return to the old patterns anytime soon. That's the message to take away. The real change isn't the price. It's the system underneath the price. And the investors who understand that are the ones who navigate the next cycle without getting blindsided. This is Gold Rush Reporter. Thanks for staying sharp and staying ahead.